Welcome everyone to the 2022 version of Keep More of What You Earn, my annual Introduction to Tax Reporting and Planning webinar. Before we begin, just one housekeeping item. Please keep in mind that the information presented on this webinar is only current as of the date of its recording, and you are encouraged to seek the advice of an accountant or tax preparer if you have further questions. By way of introduction, my name is Monique Madden, and I'm a certified financial planning professional, a financial management advisor, and recently I've also obtained specializations in the areas of divorce by way of the Chartered Financial Divorce Specialist designation, and in the area of retirement by obtaining the Registered Retirement Consultant designation. I've been specializing in personal finance for nearly 2 decades and have been partnering with nabs for almost that long. If we haven't spoken already, you might find my approach a little bit unique. I try to look at financial planning not as an effort to make the rich richer, but as an effort to provide clarity and support towards living out your goals and values. In a nutshell, think about how reassuring it would be if you knew that you had enough money to live life on your terms. That's the you potential way. I've worked with dozens upon dozens of nabs clients working both proactively to help nabs Nation to prepare for their futures, but I've also helped people make it through tough decisions in times of industry downturns. My objectives for today include a relatively painless short course on the Canadian tax system where we'll discuss a cursory review of how you prepare taxes in Canada, special considerations for 2021, and we'll have a chat about new measures that have been specifically introduced to help your family get through the pandemic. And finally, we're going to talk about things you can do to proactively put yourself in the best position possible in the future. So let's get started. When I teach people about the Canadian tax system, I try to encourage them to establish a somewhat positive and cooperative relationship with the Canada Revenue Agency. Really, all a tax return is it's a conversation. It allows you to present more information to the Canada Revenue Agency than was originally used by your accounting department to remit the taxes on your behalf. This process of presenting and sharing information back and forth continues each year, and on occasion, you might receive a notice of reassessment in which the Canada Revenue Agency has received information that might be contrary to what you reported, or vice versa. They received something from your employer that's different than what you reported. If this happens, or if CRA requests additional information, just take a deep breath. There's no immediate threat to you or your family. The best thing you can do is simply to provide the information that's requested in a timely manner. For most Canadians, the taxes that are remitted on your behalf by your employer are really based on very few things that your employer knows about you. Specifically, how old you are, how much you earned in a particular period, and then that amount is extrapolated for the whole year. In the very simplest of situations, the amount remitted is usually not too much nor too little, and what you would have is very little owed or refunded to you when your taxes are reported. Of course, it should come as no surprise that the tax tables from which your payroll department, let's say, calculates the amount to withhold and remit on your behalf doesn't always get it right. It simply doesn't know enough about you. So taxes are usually owed because of situations like additional employment sources where you have more than one employer or you have a side gig, taxable investment income, the collection of spousal support or rental income, all of which could contribute to a higher tax rate, which we're going to discuss in a minute. Refunds come when your personal circumstances lend themselves to tax relief, either because of, let's say, your good habits like making RSP contributions or charitable donations, or because of your personal circumstances, such as a period of unemployment, a disability, a large medical expense, or people who are dependent on you. For self-employed persons, the calculation and remittance is more complicated because you have to take into account also the costs of doing business. Self-employed Canadians earning more than, let's say, $30,000 per year in self-employment income also have the added burden and responsibility of remitting either GST or HST depending on the province that you live and work in. Most importantly, self-employed Canadians don't have a payroll department to remit taxes on their behalf, so they have to reserve taxes on their own. I can't tell you how many people I've worked with who found themselves dipping into their HST or tax reserve because of slower than normal sales, especially as the pandemic has hit. We hope to be offering an entire webinar on this topic later this season, so stay tuned. Fundamentally, the Canadian tax system is a graduated tax system where the first portion of your income is taxed at one rate, then the next portion is taxed at a higher rate, and so on. The combined total of these incremental calculations is the total amount of tax you pay, and the highest rate that you're subject to is called your marginal tax rate. Once provincial taxes are included in the calculations, the tax brackets aren't quite as clean or equally spaced as this, but fundamentally it works the same way, except that each province levies taxes slightly differently, and of course, Quebec has its own system entirely. So let's look at an example. If you lived in Ontario and earned $64,900 in 2020, you had your first $45,142 of income taxed at about 13.78% for a total of $6,317.95. The next $3,878 was taxed at about $936.54, which is a tax bracket of 24.15%. Then you had one more bracket on top of that to total your $64,900 in earnings. That final $15,880 was taxed at $4,708.42, being the 29.65% tax bracket. If you add all those up, the total amount of tax that someone earning $64,900 would pay is approximately $11,810, or an average rate of 17.46%. Now, the average rate is kind of important, but the most important thing for this taxpayer is actually their marginal tax rate, which I told you before. It's actually the highest band, the highest tax bracket that this person earns income at. And the reason that that's important is that if you have income from other sources, let's say from GICs or investments or rental income or spousal support, those are always tacked on last, meaning every additional dollar of income that you earn is taxed at your marginal tax rate and may in fact push you into a higher marginal tax rate. Now, the trouble comes from when you have situations where your income is from various sources and each doesn't know what the other one is remitting on your behalf. So when you're reporting income from, let's say, 2021, and you have your primary earnings plus, let's say, a second job or spousal support or rental income or investment income, each of these could push you into a different tax bracket. For example, if you earn $85,000 per year, let's say, but you had $7,000 or $8,000 from one of those other income sources, you would owe tax on that amount because your employer only knew to remit enough to satisfy the $85,000 tax bracket. But add $7,000 or $8,000 to $85,000 and you ended up moving into a different tax bracket. Now, the same can hold true in unusual circumstances in the exact reverse. Let's say you were earning at, $100,000, but you found yourself out of work for 15 weeks. Well, again, your employer remitted your taxes based on $100,000 for a full year, but you didn't earn that amount for the full year. So that actually moves you back up into a different tax bracket. So you really do have to watch what your employer remits on your behalf versus what actually happened during the year. Unfortunately, the lingo is very, very complicated. And the good news is the Canada Revenue Agency website and most tax preparing software does a really great job of walking you through all the standard credits and deductions. So I'm only going to talk to you about a few that are somewhat unusual and for which maybe a little bit of strategy is useful. Recognizing that our healthcare system doesn't cover all of our needs, the Canada Revenue Agency allows us to claim a credit on many additional costs of, let's say, medications or assistive devices. The credit is best used when it's pooled for the household. And now this can be a little bit complicated if you have children who are over 18 and are still dependent on you, but largely it's pooled for the household. Strategically, what's really interesting about this credit is that you can choose any consecutive 12-month period to claim those expenses. And the reason that's important is for, let's say, unusual expenses, such as braces for one of your children. You'll know that that's an unusual expense in 1 year, and it could in and of itself, make it easier for you to qualify for the minimums for the medical expense tax credit. So you might want to pool those 12 months around that particular event. Same holds true for, let's say, glasses or contact lenses. Those things don't necessarily happen all the time. Now, when you're reporting the expense, the software will ask you to pool these expenses and report them on the lower income earner's tax return. And that's because it's one of those wonky, lesser than calculations. After all, we are sponsored by nabs, and it's important that we understand how valuable the donation tax credit can be. The donations are a valuable tool for tax planning, but it's most effective when the donations exceed $200 a year, because the first $200 in donations is taxed or credited rather at a very low rate, but anything in excess of $200 is credited at the very highest rate. So to avoid duplicating the first $200 and the redundancy at that low rate, spouses should pool their donations and report them on one tax return. Again, this optimizes the credit for the household. Now, you may remember that the home office expense deduction was offered last year, and the vast majority of Canadians ended up working from home, so they did get a little bit of tax relief in 2020. The Canada Revenue Agency has confirmed that they will be extending that credit for both the 2021 and 2022 years. And in a nutshell, the deduction allows you to claim some of the costs of maintaining your home as your workplace and using those costs against your income. In a typical year, there would be tons of rules on who can claim this deduction and what can be claimed. But with the pandemic having wreaked havoc, the Canada Revenue Agency offered the simplified version for those who don't want to collect and submit supporting documentation, and of course a detailed method for those who believe that they'd be eligible for a larger deduction. To get the maximum, again, you'd have to have worked for 40 weeks or 10 months, primarily from home, meaning more than 50% of the time. And for those of you who may have returned to work at some point, just be sure to report the accurate ratio of the amount of time you worked at home versus worked at your office so that you're in a defensible position in case CRA asks any questions. But again, this simplified option does not require any additional paperwork or receipts. For those of you who have access to supporting documentation and the testimony of your employer through the T2200S, there is a great tool online to assess whether you might be eligible for a bigger deduction. I've worked with this a little bit, and in my experience, you really have to be in quite an unusual situation, perhaps a very small very small home, and you're using a large chunk of it for your workplace. But if you want to play with this particular online tool, I'll offer you the link in the last slide. If you have struggled to prepare your tax return in the past, may I suggest that you start with your 2020 tax return and see what you reported there. It's always easier to see what has changed than try to recreate the tax return from nothing. chances are some of the items that you reported last year will be able to be reported again. So if you start, for example, with your T4, which is the statement of your employment from your employer, that probably, will continue into 2021. Then if you have incomes such as pensions or survivor benefits, those will also likely have continued. But something, for example, like a one-off withdrawal from an RSP that you might have needed to do in 2020 because of low earnings, but didn't recur, well, then maybe that is removed from this year's item list. Similarly, and this is probably the hardest part, if you reported investment income in 2020 and you still hold those investments, then you should probably receive receipts from those same companies again this year. This is often where most of our grief comes from because a lot of these tend to go missing. So be sure to watch for this particular item. Next, if you sold investments in 2020, well, those aren't likely to recur, but you might have new investments that were sold in 2021, giving rise to a T5008. So that might, again, recur for this year. If it didn't, then you would just swipe that off the list. Unless you sold real estate or, you're no longer collecting rental income, most of those things would persist from one year to the next. Okay, so if you sold the real estate in 2020, you wouldn't see that on a 2021 tax return. The same holds true for your credits and deductions. Did you make donations? Then you're going to have to collect the receipts, the majority of which come to you by email at this point. And then take a look at whether or not you made an RSP contribution, things like that. Professional dues often carry over from one year to the next, so those likely will have continued. But maybe your children have aged out of daycare. Sorry for those of you in this situation who aren't going to be able to take advantage of the new federal commitment to $10 a day daycare. I couldn't take advantage of it either. Not that, elementary school from home has been any easier, but you know what I mean. So if you have children who've aged out of childcare, well, those will have, been eliminated. Spousal payments may or may not continue. Moving expenses are often not replicated. And finally, medical expenses that were not reimbursed by your group benefits require a little bit more effort, but again, pool them and they can be very much worth the effort. Now, only time will tell whether there will be a lingering effect on how we work once the pandemic is under control, but no matter what happens, there are a couple of quick things that we can do to help you set yourself up for success going forward. Specifically, let's look at some tax planning between spouses and how you can use technology to make your life easier. You're probably aware that an RSP contribution is the single most valuable tax planning tool for Canadians. But to optimize the strategy, contributions should be made by the higher income spouse because the refund is calculated at that marginal tax rate. You remember I talked to you about that earlier. For example, let's say a couple has an extra $5,000 to contribute to an RSP. And one spouse earns the national average, $64,900, and the second spouse earns twice that amount, $129,800. An RSP in the hands of the lower income spouse will only attract a tax deduction and a refund at 29.65%, because that's the bracket that person is in. But the $5,000 applied against the taxes of the higher income spouse will attract a refund at 43.41%, which is significantly more, especially if you're looking at a contribution well in excess of $5,000. So you do want to look at which spouse is going to be claiming the very, very valuable tax credit, the tax deduction. Of course, there are other factors, including the contribution room of each spouse, but at least consider the strategy before you put money in the account, having lost the opportunity for a much higher tax refund. And finally, we've all experienced times where we haven't been as organized as we hoped. Fortunately, there are so many ways that technology can help us to make up for those shortfalls. Let's say you're not in the habit of putting all of your donation receipts into a folder in your email. You can always search the term, and the term that I would use is official tax receipt, and those items will come up. Hopefully, going forward, you would segregate them, by year. Secondly, when it comes to medical expenses, if you're anything like our family, my husband and I both have medical insurance, and I'm able to claim some additional expenses not covered by either plan through my corporation. You can only imagine how complicated this gets. So I actually have to keep track of everything using a spreadsheet where I log each expense, whose insurance it was claimed at first, what the reimbursement was, if at all, and then move on to the next and so on. I know it sounds draconian, but it's the only way I know to get it done right and make sure that we're not leaving any money on the table. But with respect to other ways that you might need to keep receipts, let's say to claim through your workplace or for tax purposes, there are so many apps out there that can help you organize these receipts. I don't want to endorse any particular one, but check your app store. These apps can encourage you to take a photo of the receipt in question, and then it allows you to organize the receipts either by year or by the time of claim. So for example, are these to be reimbursed by your workplace, or is this ones that you want to hold on to for tax purposes? There is no shortage of ways that technology can make your life a little bit easier. Before we end this webinar, just a few resources that you can refer to for additional information. I love taxtips.ca, which gives you, current and the immediately preceding year's tax tables by province. There are all sorts of calculators and simulators so that you can play at seeing whether, something could attract a better tax refund for you or not. There's more information on the home office deduction. Again, it was very, very popular last year and will be continued through to the 2021 and ultimately 2022 tax reporting years. The medical expenses that can be claimed, there's no shortage of questions on that often, and all that information is available again on the CRA website. And finally, something we'll delve into in a special webinar altogether, business expenses and what can be claimed, whether you are a commission salesperson or not. Thank you so much for your time and attention today, and for NABS for sponsoring this content. If I can be of any service, please don't hesitate to contact me. Again, if you are planning in advance or reacting to something that's happened, please reach out. It would be my pleasure to help in any way that I can.